Welcome back, folks. You're watching Smart Money on CNBC-TV18. Very interesting episode. We've put together all the queries that we've got from young earners and investors, and we're trying to address them one by one. Mrin Agarwal, who's a financial educator, is sitting by with us. Mrin, before the break, you were telling us about the best way to invest, right? But I want to talk about some of these new age investments that kind of have caught the fancy of young investors, and I want to bust some myths. Stock baskets is one of them. So, your small cases of the world. F&O space, a lot of young investors are looking to make a quick buck through the F&O route. What is your advice on products like these?
So firstly, on stock baskets, I think it's a brilliant product. But I would just say that, you have to keep in mind what are the costs associated. Because what happens in stock baskets is that you'll have to look at rebalancing on a regular basis. And every time that you rebalance, there's going to be a cost associated, and there's going to be taxation associated as well, which is only going to increase the cost. So to that extent, you'll have to keep in mind what the costs are. Of course, it's very concentrated and, concentrated in a particular strategy. So you also need to be clear that, that's what you're really looking at. I would also say that, right now we don't have long-term data on actual performance. And, so I would actually, just keep in mind the fact that today when you're investing in mutual funds, you have a very long-term history that's available, which is not available in this case. And even though there is some backtested data available, but the actual performance data is not for a very long period, So I would keep these factors in mind before I invest in stock baskets. And of course, F&O, I think, is a complete no. I think recently the regulator also came out with a paper that actually showed that 90% of individual traders actually make losses. So I don't think, these are products for individuals. Even I don't invest in products like F&O because I think it's just too complex, requires a lot of time and effort and, monitoring as well. And I think there are simpler, easier, low-cost products that are available that allow you to spend your time in many other things than, sitting in front of the screen.
Oh, absolutely. And you get a good night's sleep, right? If you invest in conservative and low-cost products. That's what's important at the end of the day. So stay away from some of these products, maybe in the F&O space. Stay away from trading if you're a young earner. As well as, don't invest your money in a lot of these fancy products, whether it's small cases, stock baskets, unless you know a lot about this space. What about international stocks, Mrin? Many investors have direct investments in these stocks through their brokerage accounts. And given that international funds are now fully taxable, is this a good option or is it an avoid?
Yeah, I've been getting a lot of questions on this after the change in taxation. And what I would say is that while it's really easy to go ahead and buy stocks directly, most investors are not aware of the tax compliance that there is on international stocks. So one, you have to necessarily file ITR2 if you own a foreign stock. And honestly, there are, I think, 4 to 5 extra sections in the ITR2 that you need to file because you're having a foreign stock holding. And I think, most investors are not aware. And filing those particular sections are not really very easy. So you would need the help of a chartered accountant if you have bought international stocks to do the correct filing of the returns. And I just feel that, for a small extra benefit, honestly, I don't think it's worth it to go through all of that effort. Also, from 1st April, there is going to be tax collection at source that's going to be applicable on these investments as well at the rate of 20%. So and the fact still remains that, again, it's very difficult as individuals to really figure out what stock to buy, right? So I would just say that let's leave money management to the experts. As I said, you have domestic mutual funds that take international exposure. I would think that that's the easiest way to actually get international exposure.
Okay. The other thing, which is growing in terms of chatter is P2P products, right? Peer-to-peer products. So for the uninformed, for our viewers, peer-to-peer service actually connects lenders and borrowers. So enabling individuals to get loans directly from others like them. And there are, of course, investment products here as well. Now, this is regulated by the RBI, so that doesn't seem to be an issue. But do you think this is a bit of a complex product, and is it better to avoid for at least a young investor?
Yeah, I mean, honestly, I think it's quite risky because you're basically lending money to people, who may not be able to get money from other banking channels, for example, or maybe people with a lower credit score. And I always feel that, is this what you want to do with your money? Is this, you want to lend your money out? Is that what you want to do with it? So somehow I'm not in favor of these products because I feel, again, these are very nascent. We really don't know what are the default rates right now. And also, in case of a default, right, I don't know how much the platforms would really be able to help you. And I just feel that, right now we are just not aware of the sort of risks that are involved. And a lot of people are drawn into it because they're giving you this 12% and stuff like that. But anybody who's giving you, 50-60% more than what a bank deposit can give you, it does mean that it comes with a very high amount of risk.
Absolutely, absolutely. And it's not sustainable, right? I mean, money doesn't come easy. Got that. We have very little time. So there are two more quick questions I want to squeeze in. Debt funds, right? I'm sure you get a lot of queries on that. With debt funds being fully taxable now, the interest in direct investments into bonds is picking up. Many NCDs, covered bonds are giving 9 to 12% per annum. Fixed returns are available here. But how do you see these as an investment opportunity?
So again, concentrated risk, right? So if you're doing this, remember you're taking a concentrated risk because tomorrow if the company defaults, your entire capital is gone, right? And again, I've had a lot of investors asking me about these bonds. Most of them, I don't think, understand the meaning of the ratings. As long as they see a A, they think it's a good rating, but a single A versus a triple A, there's a lot of difference, right? So I think you just need to be mindful of some of these risks that are there in these instruments and not just go by the return. Also look at who is the manufacturer of the bond, which is something that a lot of people are not looking at as well.
Okay, and finally, you've told us what not to do, but just summarize it for us. What's a good way for a young earner to invest and create a rock-solid corpus?
We always try to complicate our investments when you have very simple investments available. So on the short term, which is up to 4 to 5 years, clearly up to, I would say you have fixed deposits and you have short duration debt funds available. The debt funds, although they're fully taxable, I think they'll give you a slightly higher return probably than what an FD can give you. But, if you find it difficult again to figure out which debt fund and all of that, just stick with the fixed deposit, right? If you're looking at medium term, between 5 to 7 years, right, you have balance funds that are available. You have the dynamic asset allocation category that's available over here as well. And clearly, if you're looking at above 7 years, I would say look at equity funds. I think there's some really good equity funds today in India. And for the very long term, let's say for a retirement perspective, you have PPF and you have NPS. So all of these products are extremely low cost, and have a good history of performance and have provided consistent returns. So I would say FD, balance funds, equity funds, NPS and PPF.
And two quick equity funds top of mind that stand out for you?
On the Nifty 50 fund, I like ICICI Nifty 50 fund, Parag Parikh Flexi Cap fund and DSP Mid Cap fund.
Okay, on that note, thanks a lot, Mrin. Very, very helpful for all the young investors, the young earners out there. This is a great way to build a rock-solid corpus. Thanks a lot for joining us on Smart Money.